वेलकम बैक गुड डे इन्वेस्टर्स। वेलकम टू मार्केट का ज्ञान। मैं हूं नरेंद्र सोलंकी एंड आवर टुडेज टॉपिक इज वेरी वाइडली डिस्कस्ड acronym which is Moat. Moat is a company's biggest competitive advantage and it sets itself apart from its competitors. Moat is generally referred to as something unique, something special, something very different which a company is offering. It may be a product, it may be a service, it may be an experience, or it may be an innovation through which a company takes an advantage and leads its competitive space, and that enables company to achieve tremendous success in market and resultingly in its businesses. Now, what makes a moat? So we will discuss in this video what makes a moat and what are different kinds of moat. We will also understand in detail. But let us start with how moats helps in investing. Moat investing is based on a simple concept. Invest in companies with sustainable competitive advantage, trading attractive valuations. One of its first step is implementing this approach is finding companies with a moat. But for that, we need to set to identify criteria or factors which are sources of moats. Here we refer to one study, famous study conducted by Morningstar, which we will use in this video as a template and which already lays out the structure. So there are basically 5 sources of moat which you can identify and link to a company. So let me just name out those 5 sources. First source is switching costs. Second is intangible assets. Third is network effect. Fourth is cost advantage. Fifth is efficient scale. So coming to the first, switching costs. Switching cost gives a company pricing power by locking customer into its unique ecosystem. Beyond the expense of moving, they can also be measured by the effort, time, and physiological toll it's taking to switch to another competitor. The second mode, which is intangible assets. Though not always easy to quantify, intangible assets may be brand recognition, patents, regulatory licenses. They may also prevent competitors from duplicating their products or allow a company to charge premium pricing. Second is network effect. A network effect is present when a value of a product or service grows as its user base increases. Each additional customer increases the products or services value exponentially. Third is cost advantage. The companies that are able to produce products or services at a much lower cost than its competitors are often able to sell at the same price as competition and gather excess profit, or have an option to undercut the competition. This increases their market size. Fifth is economies of scale. In a market limited in size, potential new competitors have little incentive to enter because doing so would lower the industry's return below the cost of capital. Hence, the companies which enjoy these economies of scale enjoys a larger share in overall industry and profits. Now, we will understand the minute details of each of these individual modes in our second part.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.